Hello, welcome to Accounting 2010, Chapter 15 videos, Video 2, Financial Statement Analysis. When we prepare our financial statements, we want to know how is our company doing compared to other companies. We do not live in a vacuum. We have to compete with other companies for creditors financing and investors investment income. And so we have to be cognizant that we are being compared to other companies. And this comparison is done through financial statement analysis. And there are three basic types of analysis that we will be talking about today. The first is a vertical analysis, the second a horizontal analysis, and the third are ratio analyses. So in order to do this, we are going to use some numbers for our Roadrunners Roost company. We are going to be looking at a very basic analysis and very basic numbers, but it is enough to give you an idea of what will be going on. So I'm going to go ahead and jump out to a spreadsheet that has some numbers for Roadrunners Roost, and we will use those to perform each of the three types of analysis. So the first one that we're going to look at is a vertical analysis. A vertical analysis is labeled such because it is conducted in an up and down fashion, just as you would think with a vertical analysis, with the word vertical. So the first thing that we're going to do is look at what types of accounts. We've got net sales, cost of goods sold, which you have not actually looked at yet. This is for a company that sells products, and those products have an expense related to them. So cost of goods sold is an expense account, and that is the expense, what it costs us for the products that we sold. When we have our net sales minus the products that we sold, that leaves us with our gross profit. What is left over to continue to fund the rest of our business? We will have operating expenses, those which are the expenses to have the operations. That will leave us our operating income. Then we'll have some other expenses, and that leaves us with our net income. So one of the problems when we're looking at a company and we simply see numbers, we develop what is called a dollar bias, a dollar value bias, or a number bias. We're biased when we see large numbers and small numbers. So in order to get rid of that bias, if we convert these numbers to percentages, it will allow us to compare our company to another company and see if we're doing better or worse than that company is. So in the case of Roadrunners Roost, what we're going to be looking at is converting everything as a percentage of sales. So we're going to convert everything as a percentage of sales. Sales will be 100%. 69,358 will be 100% of every other number. And what we do then is we go ahead and we're going to be dividing, if you see the 19.7%, we're going to take every other number and divide it into sales. So in the case of cost of the goods sold, the cost of the goods we sold, we're going to go ahead and divide it into sales, and that gives us 19.7%. So in other words, for every dollar in sales, the cost of our goods were 19.7 cents, 19.7% of every dollar of sales. If we had 19.7 cents went to the cost of the goods we sold, that left us 80.3 cents, or 80.3% left to cover all of our operating expenses, other expenses, to leave us with what our profit was. So we can go ahead and divide operating expenses into the net sales, 35,689 into the 69358. 51.5% of our sales were to cover operating expenses, or 51.5 cents of every dollar in sales covered our operating expenses. If we divide our operating income into our net sales, 28.9 cents of every dollar in sales left us over with operating income. The income that was left over after our cost of our goods sales and our operating expense. We have some other expenses. This could be for some things like some interest and other items. 4 cents of every $1 in sales went to cover other expenses. And at the end of the day, the 17,658 divided into the 69,358 left us with a 25% net income amount, or 25 cents of every dollar in sales was what we had in profit. Now that we've broken this down, it is easy for us to compare it to another company. So let's say that UCD had a tutoring company and we want to see how we were doing. Well, for every $1 in sales at UCD, they had 32 cents was their cost of their goods sold. That left them with 68 cents on the dollar for operating expenses. We can see then that we actually had a lower cost of goods sold. We had more gross profit. Regardless of what the numbers were to create this, if we break this down into percentages, we can compare it in a vertical analysis. And at the end of the day, we could see that 25% of every dollar, or 25 cents in every dollar, went for net income. We had 25 cents left on every dollar for net income, whereas say the UCD tutoring company only had 14 cents. So that is a vertical analysis, and this helps us to compare from company to company. In the next video, we are going to be looking at a horizontal analysis, which allows us to see how we did from year to year.